Hello and welcome to CRT Basic to Advanced Mentorship. Now we are going to start with our module 1.1 market structure, and here you will be learning how to read the market like a pro. This is one of the lessons that have helped me to understand how the market moves. So whatever strategy that you are using, it doesn't matter whether you're using trend lines, SMC, supply and demand, support and resistance, EAs, it doesn't matter what strategy you are using. If you were to apply the concepts that we are going to go through this video, I can promise you the following things: that you will have one, extreme clarity of what the market is going to do or what might happen in the market. And then second thing that you are going to do to your trading, you're going to boost your strike rate, meaning you're going to be correct more than you are not. And the third thing that you're going to do, you are going to have a high reward to risk, because you're not going to cut your trades short. You're going to leave them to get to TP. You're not going to freak out during the trade and your emotion gets the better of you. You're going to be able to have confidence in your trades that they're going to get to your TP points. Market structure illustrates the overall order flow of the market and provides a mechanical framework for reading and understanding price. And this is very important. When you have a mechanical way of reading price, of looking at price, at what the price is going to do and how to read it, it helps you not to be all over the chart. Therefore, when you understand and map the market structure correctly, first thing first, it is going to massively increase the probabilities of understanding where price is more likely to go next and understanding the behavior of how this price will be able to move to those areas. Therefore, you are going to be able to go down to your small time frames, look at the market and actually know where the market will go and how it will get to those areas. You need to have a systematic method of mapping market structure consistently, the same way every single time. If you can be consistent in your approach to analyzing the market, then you increase the probability of achieving consistent results within an uncertain market environment. What is more important when you are looking at this, it is that you need to build a solid foundation. Then everything that follows will work well. But if the foundation, it is not really built the way that it should be, and if you do not have actually a solid foundation, therefore everything that we are going to add afterwards, it is going to crumble or it will not work. Therefore, you need a solid foundation. That is very important. Therefore, the foundation of our trading should be market structure. Therefore, market structure in this case, it is king. Therefore, you will have market structure, then we'll then build the other things on top of that market structure. Therefore, the market structure will tell us how this market needs to behave, where this market needs to go, you see. So the solid foundation, therefore, it is very important. Therefore, we're going to be looking at the first structure, which it is called the bullish market structure, which it is an uptrend made of higher highs and higher lows. So in theory, what you will see, it is that the market makes a higher high and retraces to make a higher low and then goes again to make a new higher high that is above that high, right? And then we call that a higher high, and the market will then retrace to create another higher low, and then we break the previous higher high to create a new higher high. Therefore, a higher low, it is not confirmed until the market breaks the previous higher high, and therefore this higher low, it is then called a swing low as soon as we have a break in market structure. So it means that a higher low, it is only confirmed when it is breaking a higher high, and then that we call it a boss. After a boss, then we expect a retracement always. When the market has broken a high, we then expect a retracement. When the market has broken a high, we then expect a retracement. But all of this is in theory. But in reality, what the market then does, it is very different to what you might expect. The market then goes, makes a high. Instead of retracing in one leg, it makes another substructure inside here. So you'll find that the market will drop lower, will then retrace back, will drop lower, go above that high, and then it will drop, right? As it is going to form a higher low. So the market will then do that. As the market does that, you cannot then say this is a higher low or this is a higher low. You can't. Why? Because the market is not broken this higher high. When this market breaks a higher high, the lowest point of this retracement, we then mark that as a higher low, and then the market then goes higher. So one of the common mistakes that we have seen within mapping structure, it is that when the market it is coming to create a higher low right here, other traders will then look at this structure as bearish and they will then put a zone there. When the market comes into that zone, they'll be looking to sell the market, right? And the market will then go above that zone, getting them into a loss because the structure it is not like that. And then what then happens is that when the market retraces in, they'll add more trades. As they add more trades, they're adding more losing trade because the market now would have turned. They would have missed a market structure shift in this regard, that the market now is finished giving us a higher low. Now it is ready to buy to the upside. If instead of buying from this area, they will still be looking for sells, and then that's how they make double loss, and then they are scared of the market and they'll look the market go away. And then after the market is taken out a higher high right here in this area, what do we expect? We expect a pullback, and then they will do the very same thing, the very same mistake. The market will drop in, and then they will look at this as a zone where they are supposed to be taking a trade. The market will come and hit that, give them a small retracement, then takes them out. And they are making losses out of this because they are reading this structure incorrectly. This structure, it is what? It is bullish, and they need to know where they are within this market. So when we are looking at this, the lowest point over here, before that area it is broken, before the higher high is broken, that is what we mark as our higher low. After this higher high has been broken, we expect a pullback. When that pullback happens, you do not make a mistake of marking this as a structure where you're going to take your trades because you're going to be hit. This is where a whole lot of traders, they get to be trapped because they don't look at the overall market and understand where to use which concepts. So this is how you would then map out your bullish structure. Your bullish structure will make your higher highs and your higher lows. And then a higher low, it is confirmed only when a boss is created, when a break of structure, when a higher high it is created. And then after a higher high is created, we expect a pullback after breaking the previous higher high, and then we then make a new higher low. After breaking that higher high, we can then confirm that we have a new higher low. And then after a break of structure, we then expect the market to pull back and then create our new higher low. And then when you're looking at this, you will then see that this is your bullish structure. And then we're going to be looking at our bearish structure, which is a downtrend, which makes lower highs and lower lows, right? When you are looking at this in theory, you then understand that it looks smooth and nice, but it is not like this. When you go to the market, in the market, it is very much different from what you will be seeing here. It is not a nice straight line. So what is very important, it is that a lower high, it is not confirmed until we see a break of structure. Therefore, until we see a lower low broken. When this lower low is broken, then a lower high, it is then confirmed. We can then put that in place. But without this break, whatever that happens inside here, it is just internal structure. So we do not consider any of these as lower highs. So it is very important to understand that only after a break of a lower low, then we can consider that to be a lower high. And this is also called a swing high. This is a swing high that causes a lower low to be broken. So this is what we call a swing low of the structure. So a swing low has been broken. Therefore, we have confirmed that we have a lower high. And then when a pullback comes in, until the market breaks this low, we do not have a lower high, right? So this swing high, when it is broken, which we then call that a break of structure, and then we'll then confirm that we have a lower high, right? in reality, it is different from what we have. In reality, you know that the market will move high, come back, move high, come back, move high, come back, move high, gives you a retracement, move high. And with all of these, we don't come in and say, now this is a lower high. Why? Because the market, when it was dropping from here, it didn't take out this swing low. So this swing low was intact. The market didn't tap or even violate it. Therefore, we wait up until we have a high. And from that high, if the market comes and takes out a lower low, then we can then confirm that we have a lower high, you see. And then that will happen again and again as the market goes high, and someone will then look at this as a zone, and they will be looking for the market to get into this area so that they might buy, because they are, in their minds, they are bullish. But then what will then happen, because the market is bearish, the market will then come, tap into this area, give them a small profit, then breaks below, taking their stop loss. If they don't have any stop losses, what you will then see is that this person, it is in deep drawdowns, and this builds wrong habits within the market. And what will then happen is that the market will then break a lower low, giving us what we call a boss, and then the market will start retracing again. And they will see this as an uptrend. They will start engaging with it. And then when the market gets into this area, this is where the trap happens. Person will then put this area as a zone. The market will bridge that zone, come back. And then what happens? This person, because the market has retraced, then they will then see this as a way where the market is going to go to the high side, and they will see this as a grab of liquidity into the highs. But then the market will then disappoint them and take their money and go back, because they fail to see the overall trend, that the overall trend, it is bearish. So we're going to be looking at the concept of strong highs and strong lows. So we're going to start on the bullish structure, which is the uptrend. Right, when the market takes out a higher high right here, we then see that the market is willing to go higher. So what then happens, we then mark our boss right there, saying now our structure, it is going high. But then our higher low, we consider this as a strong swing low. Why? Because the market will have an interest of not violating it. Therefore, we can then sit and wait within this area and find places of interest where the market will try to protect this low, right? That is why we call it a strong low. And then a new swing high that has been created, which is a higher high, we then see that as a weak high, because it failed to push the market to this and break this low, right? This higher low. Because this high has failed to break this, then it is weak. Therefore, we want to take our trades from this area, targeting that higher high. As we target that higher high, after a boss, as usually, we expect a pullback. But as a pullback is coming, we don't expect this low to be violated, right? So what then happens is that we'll then find an area of interest within this area and say, when the market comes here, we want to trade from this area, targeting those weak higher highs, you see, and the process repeat. So the market, the goal actually here for us, it is that we want to catch these higher lows, and we want to continue with the trend, targeting those higher highs. And this is what we call following the trend, right? But in reality, as always, this is how it looks. So you have that high, which is a swing high, and what will then happen, it will go and then it will fail to take out probably a low. And as the market takes out that higher high, we can then confirm that in this area we have a higher low, and that is a strong low that needs to be protected. The market does not need to go below that. So as the market is retracing, we need to find areas of interest within this area, whereby when the market comes there, we then say this is the last line whereby we need to start looking for our entry models and whatever that people look for when the market is entered their zones. And from that area, we are then looking to target our higher high. Why? Because it is a weak higher high, because it has failed to take out this higher low. Therefore, as we trade from here, we'll then target those highs. When a boss is given, then we have a new strong higher low, or a swing low that is strong. Therefore, the market will seek to protect it. Therefore, we'll find a zone within that area. And as the market comes into that zone, we start looking for entries. And only when the market has taken out that weak higher high, we can then confirm that we have a new strong area that the market will then want to protect, right? We'll then move to your bearish side, where the market will give us the very same scenario. So when the market is bearish, you have your lower highs and lower lows. In theory, this is very beautiful. You can see how the market will then drop. But what is very important, it is that how do you confirm that, right? You can only confirm that when the market breaks a lower low. And when the market breaks a lower low, we then look at that swing high, a lower high, as a strong high. So, and then why is this a strong high? Because it caused us to have a new low. It has led to a break of a lower low. That is why we say that is strong. And when the market pulls back, we're then looking at that as somewhere but strong. And what we are saying is that that should be protected. The market should have an interest in that this area should not be broken. Therefore, we can then look for our point of interest, targeting a lower low. We consider that a lower low, or a weak low. Why? It has failed to take out that lower high. Therefore, because it has failed to take out that lower high, we are saying we want to see it broken. Therefore, it is weak. The market should be able to break it easily, right? And then we'll trade towards it. Right, so that's really our goal, catching these lower highs as continuation of the trend, targeting those lower lows, and that's how you then make your money. So in reality, what do we have? In reality, you know that the market will then make a whole lot of highs and lows as it is going up within the main leg, but then ours is to find our strong high and then say that should be protected. We can take our entries here, put our stop losses outside that zone, and say this should not be violated. Therefore, when the market comes in here, therefore we want to take trades targeting a weak lower low or a weak swing low, because that low has failed to take out a lower high. And when the market is dropping and takes out that swing low, which is our lower low, we then expect a pullback. When that pullback is happening, we want to find another new area where we'll say this is our zone. And when the market comes back into this zone, we are looking to find entries to target this low. Why? Because if this market fails to take out this high, then what we have in this market, it is that the market needs to target this as a weak low. And that is a strong high. Therefore, it is protected. Therefore, we want to trade from a strong area to a weak area, right? We want to trade from a strong area to a weak area. Therefore, this will allow us to trade and follow the trend correctly. So after that, we want to see our trend changes. When does a trend change? So when you're looking at the order flow, you will then understand that a trend changes when an expected order flow fails. Therefore, when a strong high fails or a strong low fails, then we then consider that as a trend change. It means the interest has changed. The market might want to go in the other direction, you see. So in the bullish market or in a bullish trend, the expectation it is that the price will continue to make higher highs and higher lows. But if that gets to be interrupted, we then consider that the market has changed direction. And when the market is bearish or we're in a downtrend, we expect that the market or the price should continue to make lower highs and lower lows. But when the market fails to do that, we then consider that as a change in a trend. So what you then see it is that when the market is bullish, we are making higher highs right here, and then we then make our higher lows. So as that is happening, we expect this situation to remain the same up until one of these strong areas it is then violated. And when the market violates this low, which is supposed to be strong, we then see that as a market structure shift, the market has shifted from being bullish to being bearish. Therefore, that high becomes a strong one, and now we have a weak low. So these things, they then change roles. The lows are now weak, their highs are now strong. Now when the market breaks that, we expect that to continue. That is strong, this is weak, then this is strong, you see, and this is weak. Therefore, when the market comes within this area, we're expecting it to take out a weak low. But then when the market then takes out a strong area, we then consider that as a market structure shift. Therefore, the market is changed from being bearish to being bullish. Therefore, these are strong, these are weak, right? And then the market will come out from a strong area targeting a weak area, and then those are our trend changes. When a strong area it is violated, then we find our trend changes. Now if we go into structure mapping, when we are looking into structure mapping, it is a way of marking our structure. So the way that I do it is that I do not consider this a break of structure, rather I consider this as a sweep of liquidity. The market has came from this low, swept liquidity, then push back. Someone will then say to me, this is a higher low, but they will be incorrect. This was a sweep of liquidity. Therefore, this is not a lower high. A lower high will be here. From here to there, I would have one leg. That is just one thing. And then what causes a boss, it's a full candle closure above the higher high. When the market closes with the full body candle, then we consider that as a higher high. We then expect a pullback, a sizable pullback, then we have that, and then now we have our new higher low. When the market breaks that high, that's a boss. We then have a higher high right there, right? Then map your structure that way. So anything that doesn't have any candle closure above, that's a sweep. And then when we have that closure above that higher high, that's where we then say we have a boss. So that is how we then mark our structure. So let's just go into one of these real examples. You will then see that the market comes, sweeps the high, comes back in, sweeps the high, comes back in, then we close above. Now we can consider this as a boss, and the market then retrace. Then we can have our higher low, and the market then moves, breaks this high with this candle closure above. We can consider that now a break of structure, and then it goes high. And when the market comes back and breaks the strong low, we then consider that as a strong high and this as a weak low. We have a pullback, the market breaks below, right? We have one leg to the downside, then we have a high, we have a low, and we have a high that is protected right there, and we are looking for an area where the market will come into it, and then where the market will then push it to target that weak swing low, and the market then comes and takes out this low, and we have a pullback over here. But if you were to look closely into this area, there was no candle closure here. Yes, we have a pullback. And when the market came back, we didn't have a candle closure. This was a liquidity sweep. So what then happens is that I do not consider this as a lower high because the low was not broken. Therefore, the market went high. And I do not also consider this as a lower high. Why? Because this low has not been broken yet. So still watching that, so that when the market comes and close below, then we can say this area has been broken. We have a boss right here, and then above we can then mark that as a lower high. So let's go into our charts and look at these examples. Let us look at the market structure of Boom 500 on the H4 chart. So what you will then see, let's start from this side. You'll then see that right here we have a high that is confirmed when it is broken by this candle, right? And we have a low that would consider strong, as the market from this side was bullish. So when the market then broke the strong low, you will then notice that it is broken within these candles. We then have a high that is strong, and then would wait for a pullback, which then happened right here. And then this low would be confirmed after the market breaks below it. Therefore, we have a strong high. And then from this low, when the market was going high, we then understand that was weak. That was an area that we want to target, right? Therefore, the market when goes back, and then as it is coming down, we are targeting this weak low, and the market then breaks the weak low. And then we are looking at that as a strong high. We don't want to see the market breaking that area. If it breaks that area, therefore we are bullish. That's a shift in market structure. What you will then notice it is that the market then breaks that area, and then we then see this area as a strong low, and we do not see any reason why the market should break that area. Therefore, the market then retrace. And then we then look at that high as an area where the market needs to break and close above, so that we can have our low that needs to be protected. Now, what then happened was the market then closed, gave us a retracement, then goes above that high. As for me, as I am looking at that market, at that point, this is a strong low that does not need to be broken. The market then comes and break this low. When the market breaks this low, now I have that as a strong high. I have this as a weak low. When the market retraces, then I am looking for entries to target the weak low, this newly created low. And the market comes and takes out that low. Therefore, this becomes my new strong high. Sit there, right? The market comes here, and then we are looking for entries. We took entries as the market was coming down. This was our target. But unfortunately, the market came and closed above this strong high. Then we are looking at this low as strong. It should not be violated. And we are looking at that as weak, right? Therefore, the market went up, then took that high, and then now we have a new strong low, right? And then we are looking at a weak high. The market takes out that weak high, and then we are looking at this low as a strong one. We don't want to see the market goes below this low. Therefore, when the market gets here, we then know that this is strong. Therefore, the market needs to go high. If the market breaks this low, then we have changed direction. Therefore, the market then goes on targeting the weak highs. When the market has tapped those weak highs, we're looking for a retracement. This is strong, and then that is weak. Above, those highs are weak. The market goes above those weak highs. Then we have new strong lows below here. Therefore, from this low to that high, we don't want to see the market coming below these lows, because that would tell us that the market has changed direction. We are bearish if that happens. Therefore, the market does its retracement, and then we have our new weak high. The market goes above a weak high and then give us a retracement. Now we have a strong low, a new strong low. Now we're looking at a new week high, and the market then give us a retracement, then takes out a high, and then now we have a new strong low, and the market comes back to a strong low, and then we then target that high as a week high, and the market continues just like that up until it then breaks the strong low that you're looking at, and then that's where you get to turn to the other side of the market. So let's go and look at currency pairs and see how we can map out our structure even there, because this works in any markets. Here we are looking at our GBP USD. This is a daily chart, and we want to map our structure, right? We want to look at how this works here. So let's just take this and say that's our high, and this is our low, right? And this low then gets to be broken, and we then say this high over here on top, it is a strong one. We don't want to see it violated, right? The market goes as far as there, and then the market retrace, and this is days. Remember, this is a daily chart. So when the market was here, where we were looking at this as a strong high, there were few days of market dropping, right? With some retracement, drop, retracement, but the market dropped for a good number of days in an area where we would have thought that that was a strong high, right? Even if it didn't get to the bottom, but would have profited from that. So what then happened was the market then took out that high, right? Now we have a strong low below there and a weak high. The market retraces and then takes out that high. So this weak high was taken out. Now we have a new low, and that high, when it was taken, we expect a pullback. The market gives us a pullback and then goes high. Therefore, when that high was broken, we then looked at this as a strong low, right? And the market comes and takes out that low right over here with some retracement into that low, and the market drops. So when all of this is happening, we have our high, and then we look at this area as our low, and we have a retracement, break a swing low, that is weak. Now we have a new high, and we have a new low. The market retrace, and then it then drops below these lows right here, and then we have our new high and our new low. The market then retrace into this area, then it drops. Then as for me, I'm looking at that as a strong high, and this below here as a weak low, right? But then lo and behold, the market breaks above that high, and then I then change direction, and I think now this is strong and anything above is weak. Then the market goes high, we have a retracement, we then push high. We're taking out those highs. Then these lows, I then look at them as strong because we've just taken out those highs. Therefore, these highs over here are the ones that are weak. Therefore, I'm targeting those. When the market was here, we target those. Now we have a strong low and a weak high. The market then takes out the weak high, and from that point onwards, I have a strong low, and the market then retraces and takes out those highs right there. Then what do I have from that point onwards? I then have this area as a strong low and a weak high. I'm expecting the market to go and then take out that high. The market taps in here. We're looking for buys. We then bought, and the market failed to take out the high. Then that high, because the market failed to take it out, the market then dropped and took out this strong low. Therefore, our bias has changed from bullish to bearish. Therefore, I have that high as strong. I have this low as weak. So what then happened, what is happening currently, it is that the market then retrace into our strong high over here, and then tapped into that, and currently we are seeing the market going, targeting our weak low. And then as soon as the market takes out our weak low, we'll then say that high it is a strong high, we'll then wait for the market to retrace into whatever area that would have pointed, and then would have traded that. And then that's how you would have looked at this market. If you were looking at market structure, you would know that you are overall bearish. Therefore, you would do well to look for bearish signals. So this is how you map structure. Until we meet again on the next lesson.